What if you could make money while enjoying your morning coffee, or even while you're fast asleep? Welcome to Prosperity Pulse Point. Today, we're diving into a topic that has the potential to change your financial future: living off dividends. Imagine a life where you don't need to worry about your bills, where you have extra money to spend or save, and you're not tied to a 9-to-5 job. Sounds like a dream, right? Well, it doesn't have to be. Warren Buffett, one of the world's greatest investors, has spent his life mastering the art of making money while he sleeps. His secret? Dividends. In his own words, if you don't find a way to make money while you sleep, you will work until you die. Dividends are not just an extra paycheck. They can be a path to true financial freedom. In this video, we're going to explore on how you can use Buffett's proven strategies to build a steady stream of dividend income. We'll break down the different types of dividend stocks, reveal some smart investment strategies, and show you how to combine them to maximize your earnings. Whether you're just starting out or looking to refine your investment strategy, stick around, because this video could be your first step towards living off dividends faster than you ever thought possible. Chapter 1. Understanding Dividends. To kick things off, let's get a clear understanding of what dividends actually are and why they're such a powerful tool for building wealth. Simply put, dividends are payments made by a company to its shareholders, usually from its profits. If you own shares in a company that pays dividends, you receive a portion of the company's earnings, often on a quarterly basis. It's like getting a paycheck, but without having to work for it. But not all dividends are created equal. Some companies pay high dividends, while others pay little to none. Typically, well-established companies known as blue-chip stocks pay higher dividends because they have stable profits and don't need to reinvest all their earnings to grow. Companies like Coca-Cola or Johnson & Johnson fall into this category. On the other hand, newer or faster-growing companies might pay lower dividends because they reinvest most of their earnings back into the business to fuel further growth. Now, let's talk about the different types of dividend-paying stocks. First, we have blue-chip stocks. These are solid, reliable companies with a history of paying dividends consistently. Then there are dividend growth stocks, which not only pay dividends, but also consistently increase them over time. Finally, there are riskier options like covered call ETFs, which can offer much higher yields, but come with more risk. Warren Buffett himself prefers investing in companies that pay stable, sustainable dividends because it shows the company is financially sound and committed to rewarding its shareholders. He's known for saying, "Do not save what is left after spending, but spend what is left after saving." This approach, when applied to investing, means focusing on building a strong dividend portfolio that can provide you with steady income, allowing you to reinvest and grow your wealth over time. Now that we understand what dividends are and why they matter, let's dive into some strategies that can help you start living off dividends as quickly as possible. Chapter 2. Strategies to live off dividends. We'll look at three main approaches: investing in blue-chip stocks, dividend growth stocks, and covered call ETFs. Each strategy has its unique benefits, so let's break them down. Strategy 1. Blue-chip dividend stocks. Blue-chip stocks are the cornerstone of any solid dividend portfolio. These are well-established companies with a strong track record of financial stability and consistent dividend payments. Think of companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble. Investing in these stocks is like building a sturdy foundation for your financial house. They provide steady, reliable income even during market downturns. For example, let's say you want to earn $2,800 per month from blue-chip stocks. If you invest in a mix of these companies, with an average dividend yield of around 5%, you would need to invest roughly $672,000. While this might seem like a large sum, remember that blue-chip stocks offer more than just dividends. They also have potential for capital appreciation, meaning their value can grow over time. This makes them a relatively safe and dependable choice for long-term income. If you're looking for a stable, worry-free way to generate income, blue-chip dividend stocks are a great place to start. Strategy 2. Dividend growth stocks. Next, Let's talk about dividend growth stocks. These are stocks that not only pay dividends, but also increase their dividend payouts consistently over time. This is crucial because it helps your income keep up with inflation and allows your returns to compound year after year. Companies like Microsoft and Visa are great examples. They're not only leaders in their industries, but also committed to rewarding their shareholders with growing dividends. To illustrate, let's consider an investment goal of $2,800 per month. With dividend growth stocks offering an average yield of around 3% and an annual growth rate of about 10%, you would need to invest approximately $1.12 million upfront. However, the beauty of this strategy lies in its long-term benefits. As the dividends grow, your initial investment will generate more income each year, reducing the time it takes to reach your financial goals. Plus, the value of these stocks often increases over time, adding another layer of potential returns. This makes dividend growth stocks an excellent choice for those who are willing to be patient and watch their investments grow over time. Strategy 3. Covered call ETFs. If you're looking for a faster, more aggressive way to generate dividend income, covered call ETFs might be the answer. These funds use a strategy where they sell call options on the stocks they own, generating extra income that is distributed to shareholders as dividends. While this can lead to higher yields, it also comes with higher risk and potential for limited capital gains. Let's say you're aiming for $2,800 per month in income from covered call ETFs. With an average yield of around 12%, you would need to invest approximately $280,000. This is significantly lower than the amount needed for blue chip or dividend growth stocks, making it an attractive option for those who want to see results more quickly. However, it's important to understand the trade-offs. By selling call options, these ETFs may miss out on big gains if the market rises sharply. So while they can provide high income, they may not be the best choice for everyone, especially if you're looking for long-term growth. By understanding these three strategies, blue chip stocks for stability, dividend growth stocks for increasing income, and covered call ETFs for high yields, you can create a diversified portfolio that suits your financial goals and risk tolerance. Chapter 3. Combining strategies for optimal results. Now that we've covered the three main strategies, blue chip stocks, dividend growth stocks, and covered call ETFs, it's time to see how we can combine them into a powerful portfolio. By blending these strategies, you can balance risk and reward, ensuring steady income while also benefiting from growth and high yields. Balanced portfolio approach. Creating a balanced portfolio means investing in a mix of assets that complement each other. For example, you might allocate 50% of your portfolio to blue chip stocks for their stability and reliable dividends. Then, you could invest 30% in dividend growth stocks, which offer lower initial yields, but the potential for increasing income over time. Finally, use the remaining 20% for covered call ETFs to boost your overall yield with high monthly payouts. This diversified approach allows you to capture the benefits of each strategy while minimizing risks associated with any single type of investment. It's a smart way to build a robust income stream. Portfolio allocation example. Let's put some numbers to this. If you had a total investment of $600,000, you could allocate $300,000 to blue chip stocks, yielding about $15,000 annually. Then invest $180,000 in dividend growth stocks, yielding roughly $11,600 in the first year, but with the potential to grow significantly. Lastly, put $120,000 into covered call ETFs, which could generate around $34,200 annually. Combining these, your portfolio would yield approximately $60,800 per year, or $5,066 per month, almost double the income of a single strategy approach. This way, you're not only ensuring a steady cash flow, but also positioning yourself for long-term growth. Buffett's view on diversification and long-term holding. Warren Buffett often says diversification is protection against ignorance. While he's not a big fan of over-diversification, a balanced approach within dividend investing can protect you from market fluctuations. He also emphasizes the importance of holding quality companies for the long term. By investing in a diversified portfolio and holding these investments over time, you allow the power of compounding to work in your favor. The goal isn't just to earn dividends, it's to create a sustainable financial future. With this diversified approach, you're well on your way to building a reliable income stream that can support you for years to come. We've covered a lot today, from understanding what dividends are to exploring 3 powerful strategies for living off them: blue chip stocks for stability, dividend growth stocks for growing income, and covered call ETFs for high yields. By combining these approaches, you can create a diversified portfolio that not only provides a steady income, but also grows over time. Building wealth through dividends isn't a get-rich-quick scheme. It requires patience, consistency, and smart investing. So start planning your strategy today. If you found this video helpful, don't forget to like, subscribe, and leave a comment with your thoughts on dividend investing. See you in the next one.